Silver investors, a Wall Street veteran who called the 1987 crash, the 2025 silver bull run, and the January 2026 pullback is now saying silver could hit $300 to $500 per ounce, potentially by this summer. If that sounds insane, remember, the same analyst, Michael Oliver, has been using the same momentum system for 50 years to spot market energy building before it explodes on the chart. I'm OG John AG, and in this video, I'm going to break down who Michael Oliver is and why his track record matters, how his silver-gold ratio math gets you to 300-500, why he says the January crash was an intentional shakeout, how Shanghai's ban on naked silver shorts could act like jet fuel on a squeeze, and what practical signals to watch so you don't get shaken out right before the move he's talking about. Segment 1. Meet the analyst who dropped the bombshell. Before we touch the $500 number, you need to know why anyone listens to this man. Michael Oliver has been analyzing markets since 1975, 5 decades of watching cycles, founded Momentum Structural Analysis in 1992, working primarily with institutional clients, the funds and desks that move real size, opened his research to individual investors only in 2015. Unlike traditional chartists drawing lines on price, Oliver converts price histories into a momentum oscillator, a way of measuring underlying market energy that can show stress or buildup before price breaks. Track record highlights: called the 1987 Black Monday crash ahead of time, one of the worst single-day collapses ever, anticipated the 2025 silver bull run while mainstream media ignored metals, warned about the January 2026 silver pullback before it hit. That sequence, big crash, big bull, big correction, all nailed by the same method is why his new call isn't being shrugged off by serious players. Segment 2. The $300-500 call, not pulled from thin air. Oliver's headline call: silver could reach $300-500 per ounce in 2026, potentially by the summer. He's not saying, I feel like it could. He's saying his momentum models and the silver-gold ratio suggest that kind of move is mathematically consistent with past cycles and current energy buildup. To understand that, you need to see the ratio logic. Segment 3, silver-gold ratio, from 1% to 6%. Start in 2024. Silver traded at roughly 1% of gold's price. If gold was 2,000, silver was around 20. By spring 2025, the ratio doubled to 2%. If gold was 3,000, silver sat near 60. That doubling in ratio sounds small, but it's a huge revaluation in how the market prices silver relative to gold. Historical peaks: 1980 Hunt Brothers squeeze, ratio around 6.5%. 2011 precious metals bull, ratio around 3.1%. Right now, we're around 2%, below both prior peaks. Oliver and others also note, in past secular bull runs, gold itself has gone about 8x from trough to peak. He and many macro analysts see $8,000 per ounce as a realistic target this cycle if gold repeats that behavior. Now plug in the ratio math. If gold hits 8,000 and silver is just 3% of gold, silver owes 240. If gold hits 8,000 and silver reaches 6% like 1980, silver owes 480. That's where his 300-500 range comes from, a blend of historic silver-gold ratio peaks and a plausible gold target cross-checked against his momentum signals that say the move isn't exhausted yet. It's not wishful thinking on a whiteboard, it's ratio math plus structural momentum. Segment 4. The January 2026 crash as an engineered shakeout. Now the part that hits you emotionally, January's brutal pullback. Silver fell hard from its highs, enough to convince mainstream commentators to scream bubble and many retail holders to bail out. Oliver's view, explained in the video, that drop was not random noise. It was a designed shakeout to flush out weak hands, provide liquidity so large institutional shorts could cover and reposition. Mechanics: to cover big short positions and flip long, large players need sellers. Best way to create sellers is to scare people. Headlines about bubble bursting and scary candles do that job. He argues, investors who believe January marked the end of the bull will likely miss the next leg. They'll watch silver recover to old highs, call it a fake out, and only chase back in when price is already halfway to his target. That's the classic wealth transfer pattern, from impatient to patient, from emotional to analytical, from people reacting to headlines to those following structure and momentum. Segment 5, the roadmap, reclaim 120, then ballistic, Oliver's timing map, as summarized in the video. If February's consolidation continues without a major external shock, his target month for the next bull leg to start is March. Step 1. Silver returns to recent highs around $120. Once those highs are reclaimed and held, he expects the move to go ballistic. Why ballistic? Because the shakeout has already seeded doubt. Many former bulls will be too traumatized to jump back in early. As price grinds higher without giving them the cheap re-entry they want, FOMO builds. Eventually, they capitulate and buy much higher. Their late buying adds fuel on top of an already strong move, turning a trend into a parabola. That's the psychology behind many parabolic spikes. Not magic, just delayed belief colliding with structural buying pressure. Segment 6. Structural drivers. Deficit, demand, and dollar debasement. Oliver doesn't just lean on charts. He anchors his momentum call in 3 fundamental drivers. Structural supply-demand imbalance. Silver is both a monetary and industrial metal. It's essential for solar panels, electronics, medical tech, and defense. Demand has kept rising while mine supply struggles, new projects take years, and existing mines deplete. The imbalance is structural and getting worse, not better. Dollar devaluation and M2 expansion U.S. M2 money supply has ballooned over recent years. When you measure silver in dollars, you're measuring against a unit that is itself being diluted. A $20 silver price in 2015 is not the same as $20 today because the dollar is worth less. Framed this way, 300 to 500 silver isn't silver going crazy, it's dollars continuing to slide while silver roughly maintains purchasing power. 30-year Treasury weakness and sovereign debt risk. The long end of the U.S. yield curve, especially the 30-year bond, is flashing stress signals. If investors lose confidence in U.S. sovereign debt and demand higher yields, the entire financial system feels it. A bond market confidence crisis historically sends capital flooding into hard assets that are not someone else's liability, gold and silver. Put together, tight physical supply, rising structural demand, debased measuring stick, growing sovereign debt risk. That's the macro engine behind his momentum view. Segment 7. Shanghai bans naked shorts, jet fuel on the squeeze. One of the most explosive pieces in the video, Shanghai's rule change. The Shanghai Futures Exchange has officially banned naked silver contract positions without approved hedging quotas. In plain English, for years, traders could sell paper silver contracts, effectively shorting or adding selling pressure, without owning or hedging actual metal. This paper silver could be created in huge amounts, overwhelming physical demand and sitting heavily on the price. Shanghai's new rule: if you want to short silver on their exchange, you must have a legitimate hedge. You can't just print paper claims and push price down with no metal behind you. Immediate implications: speculative naked shorts are forced to cover or reduce. Covering shorts means buying. Buying pushes price up, which pressures remaining shorts, which causes more covering. Oliver says this could be jet fuel for a short squeeze, especially if it unfolds while physical demand already exceeds supply and Western exchanges are experiencing delivery stress. Remember, futures were supposed to reduce volatility by helping producers and consumers hedge. In practice, they became leverage machines that add artificial volatility. Shanghai's move is a partial return to that original purpose and a major blow to price suppression tactics. Segment 8. How to read pullbacks. 3 key signals. Oliver doesn't say silver will go straight up. He explicitly says it will pull back and scare you. The skill is knowing which pullbacks to endure and which ones to fear. His framework uses 3 indicators. Silver-gold ratio behavior. If silver pulls back but the ratio versus gold holds steady or keeps improving, it suggests the revaluation in favor of silver is still intact. Silver is taking a breather, not losing its structural bid, physical premiums. If paper spot drops but dealers still charge significant premiums, it means physical demand hasn't vanished. The paper market and physical market are telling different stories, and Oliver says trust the physical. Lease rates, high borrowing costs. Lease rates for physical silver during a price dip signal tightness. In a truly oversupplied market, leasing metal would be cheap. Elevated lease rates in a correction means someone is scrambling for metal behind the scenes. These don't tell you tomorrow's candle, but they help you classify a pullback as healthy shakeout in a strong trend, or warning sign of a trend actually dying. That classification is worth more than any single price target. Segment 9. Media narratives versus reality. The video also calls out a pattern in mainstream coverage. When silver is quiet and building energy at low prices, media ignores it. When silver starts moving, media calls it a bubble. When silver pulls back, media celebrates that the bubble burst. When silver blasts to new highs, media acts shocked, asks, "How did we miss this?" If you follow that script, you buy late, sell low, repeat. The host's takeaway. Don't ignore all media, but understand their incentives. They sell attention, and fear, greed headlines get clicks. Calm structural analysis rarely trends. That mismatch creates opportunities for people who can see through the noise. Segment 10. What to actually do with this. The video is clear. This is not financial advice and doesn't know your situation, but it offers a decision framework. An analyst with a 50-year record who has called a historic crash, a major bull run, and the recent pullback is now forecasting a potential 300-500% move in silver. That doesn't demand blind faith. It demands serious consideration. Do your own research. Understand the thesis and risks. Decide on position sizing that wouldn't ruin you if he's wrong. Also ask, how would you feel if he's right and you did nothing? His core challenge to you. If you believe the thesis and have done the work, don't let a pullback shake you out. The pullback is the test separating people who profit from people who fund the move. If you're still learning, keep digging now, not after silver is already at 200. We are living through a rare convergence. Monetary experiments, massive debt, inflation waves, de-dollarization moves, and structural metal tightness all at once. Oliver's view is that the energy building in silver is historic. And even if he's only partially right, a move to 200-250 would still be enormous. You've been watching John AG here, and I'm OG John AG. If this helped you see why a $500 silver call from this specific analyst is more than just clickbait, hit like so this kind of deep dive doesn't get buried. Subscribe and turn on all notifications, because if the shakeout phase really just ended and the next leg is setting up into summer, the worst place to be is waking up after the move, wondering how you missed the signals.